Good afternoon from sunny Amsterdam, which is very nice today and no rain and a very pleasant summer here. So welcome to today's webinar. The theme of the webinar today is factors driving change in the application of the profit split method. This is already third webinar in the webinar series on the profit split method. We have completed the two previous webinars on the application of the profit split method in financial services, asset management, and insurance in June. And also in May, we started with the complexities of applying the profit split method. So today's session will discuss the profit split method in a dynamic world and also the factors that driving change in the application of the profit split method. I'm happy to announce that today two excellent speakers join our webinar. Professor Scott Wilkie and Dr. Richard Kohler. Scott Wilkie is a distinguished professor of practice of the faculty of Osgood Hall's Law School at York University in Canada. And he's also a senior counsel to Blake, Castles, and Graydon, of which he is a retired partner. And Scott is the immediate past vice chair of the Permanent Scientific Committee of the International Fiscal Association and a former chair of the Canadian Tax Foundation. Dr. Richard Kohler is Associate Fellow at the Oxford University and Fellow at the University of Amsterdam. He's a former partner at PwC UK. He has been very closely involved with the work of the OECD since the late 90s and was especially active in the BEPS project. In 2019, he was appointed on secondment as a senior tax advisor to the OECD to manage the work on Pillar 1 of the OECD's work on taxation of the digitalized economy. He has worked on a wide range of research projects at Oxford University, especially on tax treaties and transfer pricing and the implications of the BEPS project and also other projects. So I would like to give a bit of brief comments about today's session and approach that we will take in today's session. Today's session will be divided in 4 different blocks where we discuss different factors that drive changes in the application of the profit split method. The first factor and the first block of questions that we will address in the discussion is the guidance itself that has changed in 2018 and was also included only in the recent version of the transfer pricing guidelines. It was released by Working Party 6 and fulfills the aim established by Action 10 of the BEPS Action Plan by clarifying and expanding the guidance on the application of the transactional profit split method. And in 2019, the Joint Transfer Pricing Forum published so far the last report. Potentially we'll see more reports from the Joint Transfer Pricing Forum on the application of the profit split within the EU. So after 5 years adjusting transfer pricing models, we can now evaluate the benefits and the challenges offered by this new guidance included in this report. The second block and the second factor that we would like to address is the BEPS transfer pricing changes that have addressed overall changes in the tax international landscape. So the BEPS initiative emphasizes a broader perspective on taxation and moving beyond only a one-sided jurisdictional view. The OECD sees profit splits as a potential solution alongside increased transparency and multilateralism in international taxation. In addition, changes made by BEPS, especially the risk framework that is now incorporated in Chapter 1 of the OECD transfer pricing guidelines, have in practice put a much greater spotlight on the relevant functional activity and, in particular, decision-making in practice, which has led to increased use of profit split based on this functional activity. In addition to these two factors, the third factor that we would like to address is the changes in the way business is conducted that are bringing new challenges also to the TP system. For example, platform ecosystem, decentralized business model, parallel non-sequential operations, and contributions to the value creation. And last but not least, all these changes put an additional pressure on the correct way or determination of the correct way of the application of the profit split method. So the discussion will explore these changes and will be divided in the same blocks. And with this, I would like to give the floor to our speakers and also to start with the first question on the new version of the profit split method, which is, how do you think that whether the guidance that was proposed by the transfer pricing guidelines on the profit split method, whether the new rules and the exercise paid off or not, what are the advantages and disadvantages on the application of the new guidance? And maybe I would address this question to Richard, to you.
Okay, thank you. So let me just explain a little bit about what's in the guidance. It's we talk about it as new guidance, but it's actually finalized in June 2018. But like most things, most changes, it takes some time to filter through. So let me just give you a brief overview of the profit split guidance. It's a fact that the OECD has acknowledged the profit split method since its first work on transfer pricing in 1969. But initially, the idea was that profit split methods would be used in very exceptional cases. And not surprisingly, the early guidance was very thin, very brief. However, profit split method has been one of the 5 OECD recognized transfer pricing methods in the transfer pricing guidelines since 1995. And the current state of that guidance, which is the revised guidance, is that we have much more detail in the guidance that we're now talking about. It's around 40 pages, about 20 pages of guidance in Chapter 2 of the transfer pricing guidance, plus about 20 pages of examples in the Annex 2 to Chapter 2. So effectively, what's happened through this process of revisions to the profit split guidance in the period 2016 to 2018 is that the guidance has more than doubled. The work took place in the post-BEPS sphere. It was one of the tasks that was initially going to be done in BEPS, but that didn't happen. And so we had successive drafts trying to change the guidance in July 2016, then June 2017, and a final revision draft, final revision in June 2018. So this was done over a 2 to 3 year period. Now, the guidance retains the basic approach that the profit split method is applicable where it's found to be the most appropriate method. And that means that merely having a lack of comparables by itself is not sufficient to warrant the profit split method. Under the guidance, there are 3 key indicators that tell you when a profit split method might be appropriate. And those 3 situations are, firstly, when each party makes unique and valuable contributions. Secondly, where the business operations are highly integrated, such that contributions of the parties cannot be reliably evaluated in isolation from each other. And thirdly, where the parties share the assumption of economically significant risks or separately assume closely related risks. And in applying a profit split, as many people will very well understand, there are 2 basic approaches. There's either the one-stage contribution analysis, where you look at the profits and divide them in total, or there's the 2-stage residual analysis, where you first deduct, you make a deduction for contributions for which market comparables exist, and then divide the balance in much the same way you do with a contribution analysis. The second approach, the residual profit split, tends to be more important. The guidance also includes some comments on the factors that you might use to determine how the profits are split, referring to things like people-based factors, sales-based factors, asset-based factors, or cost-based factors. The use of factors is intended to be contextually determined. And you can use one or more factors according to the circumstances. And as I also mentioned a couple of moments ago, the new guidance has about 16 examples showing how the principles work. And so that's very loosely the shape of the new guidance. And in answer to the question you asked me, Svetlana, I do think that the work was improved over the period. The guidance was significantly increased in the amount of the guidance. And I think it was basically a successful output. I would say, particularly if you contrast that with the post-BEPS work on the PE issues, which went on at roughly the same time, which I think was markedly less successful, you can see the work on profit split was quite good. Now, that doesn't mean that the guidance is by any means perfect, and I think in the next hour or so, we'll be exploring a number of the problems and issues with it.
Thanks. Thank you for the overview first, and then for your opinion. And Scott, do you share the same view that the guidance has improved the operation of the profit split method?
Well, there are two questions in your question. Has the guidance improved? I think for the reasons that Richard has mentioned, the guidance is certainly theoretically improved as guidance. Whether the guidance is improved in practice, though, I think is a different question. One of the things that's notable in the new guidance is the culmination of what amounts to an erosion in the second best outlook on profit splitting that was originally in the OECD's transfer pricing guidance. That is, by 1995, as Richard said, profit split had acquired a higher degree of respectability, increasingly not a second best method, but a method that, for the reasons he said, may well have to be the default method in the case of the presence of a number of the factors that support the application of a profit split method. I'd say two things about those factors that underlie the decision to apply a profit split that are, I think, quite critical. And we will talk about this in a multilateral context in a little while. First of all, I think in practice, most multinational enterprises, focusing on the word enterprises, and without using loaded language like unitary, are homogeneous as business enterprises. That is, the diffraction of these economic homogeneity into legal bits and pieces and transactions that are connecting them is entirely, artificial. And so, depending upon what theory of the business firm one subscribes to, it's not that hard to imagine that all members of an enterprise, even those that are contributing so-called routine functions, in one manner or another are contributing to the uniqueness of the enterprise distinguished from other enterprises. They're all integrated. They're all integrated. And again, risk sharing, as we'll talk about later, whether we do it on the old paradigm of transactional transfer pricing between entities, or with the influence of the mindset of profit splitting, which is splitting the profits of the enterprise relating to the internal transactions, as if the enterprise had not been separated into its bits and pieces using various legal constructions. I think that the focus much more clearly in the profit split guidance has been to realize that there is some fallaciousness almost in the traditional paradigmatic separate entity transfer pricing approach, which just doesn't work anymore, and that's connected to BEPS. The second thing, which I think is quite important in practice, and it's starting to creep into legislation in various places, including Canada, is that more generally through the guidance in Chapter 2 with respect to the, quotes, accurate delineation, close quotes, of the tested transactions, the second guessing of their commercial rationality, and the search for, quotes, value creation, tax authorities are reserving to themselves an entitlement basically to disregard how taxpayers construct their affairs, even if an evidence-based analysis would show that they respected and conducted themselves appropriately with respect to how they've organized themselves. I think that in combination with the greater recognition of profit splits has significant implications for not only for how tax authorities go about evaluating taxpayers' transfer pricing, but the workability of a multilateral approach.
And do you think that there are maybe some key specific areas, Richard, that still might be improved? So if you would just choose one or two key areas.
Yeah, I mean, there are some of the really key phrases, like what is highly integrated, what's the sharing of risks. These things are all a bit subjective, and in practice, when you're doing profit splits, you end up arguing about them. So that's probably not news. That's probably inevitable that that is going to happen. The other thing that it's fair to say is that, like all OECD guidance, it's written in very defensive terms. There's quite a high level of caution in the way that the OECD writes, understandably, and many reasons for that. But what it means is that the guidance can be less useful at times in practice. You see this in the examples. All the examples use objective factors to illustrate something, whereas in practice, we often don't have objective factors like sales or costs or assets. We're looking much more at people factors, for example. That's much more common. And some of the reasons we do that we'll come on to look at. And of course, once you start using people factors, the guidance starts being less useful to you, and you hit problems of subjective assessment of what counts, the fact that people might change from one deal to another, and there's just no easy metric to use as a proxy when you're doing profit splits for the contribution of people. You've basically got compensation, headcount, or some kind of metric that measures decision making, and there's pros and cons of all of those. But what there isn't is a discussion of this, a really good discussion of this in the transfer pricing guidelines, because they're written in this rather cautious way, which I completely understand, but it doesn't help, and it could be improved. And the position, as Scott's alluded to, the position is made worse by the impact of the BEPS risk control rules. And I think the plan is that we might come on and say a little bit about that. So some improvement would be nice, but it may not be realistic.
Yeah, I just like, if I can say, I mean, I agree with what Richard just said, and underlying this, although almost always unspoken, is that despite the appearance of the guidance, even with a defensive tone, the guidance is the culmination of tax authorities sharing their resources in order to produce what are called the transfer pricing guidelines. I mean, the transfer pricing guidelines are the outlook of tax authorities collectively on what the appropriate standards are for testing whether or not multinational enterprises have used their common control in an unwarranted way to divert income from where it would be considered to have been earned. I mean, that's the essence of the transfer pricing guidelines. But the point I'm making is that the tax authorities are, as economic actors in relation to each other, not on the same page. They have different interests that are their country's interests. And so the question ultimately, no matter how finely tuned the theoretical guidance may be, and it's certainly better, is how do you weight these various factors? That is, what's relatively more important than another factor? Does the origination of the intangible in country A, is that more important? Is that the source of the driving influence of the enterprise, or are successive improvements in country B by the country B affiliate on the platform of country A's work more important as the original work outdates? What about what happens if even within a year or from year to year, the balance of the factors, even the people factors, changes? Does the allocation of profit of the enterprise change on a year-over-year basis so that a taxpayer doesn't actually know from on a predictable basis how its reported income is going to be received by tax authorities that it has some connection with? So while the theoretical guidance is fine and substantively, I think, unchanged from how it originated, how it applies, how any of this applies, is really the ultimate test of its utility.
And I think with this, it's a good time to turn to the next block and discuss different BEPS changes. So one of the aspects that we have also addressed in the previous webinar, and it was considered to be one of the key problems of the application of the profit split is that on the one hand, it's good that it allows you to see the whole picture, how the business operates. On the other hand, it actually becomes a bit more complicated to apply profit split in a multilateral way, while, for example, that tax treaties are still being implemented only in a bilateral way. So with this, as a general matter, the BEPS project encouraged a greater effort on the part of the tax authorities to see the whole picture, so not just one-sided picture. So, Scott, do you think this is a leading to greater use of profit split, or do you think that it made the application of the profit split method even more difficult and sometimes challenging?
Well, I think, as I said at the outset, I think that notwithstanding what the guidance says and how it has prioritized approaches and what tax authorities may say, I think it's always in the mindset of tax authorities that they're profit splitting. That's how they think about it. And they tend to think about it in spite of how taxpayers have organized themselves legally. And I'm not talking about legal maneuvers, schemes to divert income. I'm simply talking about how multinational enterprises are in fact and legally constructed. And so, one of the points that's worth making quickly is that it's impossible, I think, to apply profit splits on a unilateral basis. I mean, tax authorities don't like unilateral approaches to transfer pricing anyway. And the experience with mutual agreement procedure and tax treaties and the experience with APAs it reflects that. So inherently profit splitting, if you're it involves looking at an enterprise as a whole, even according to internal transactions, and it involves parsing, dividing up, allocating countries' entitlements with respect to the income of the whole, with respect to the affected economic events, the affected transactions. So keeping that thought in mind, the essence of BEPS Pillar 2, for example, is exactly that. What BEPS Pillar 2 essentially says is, regardless of how multinational organizations have organized themselves legally into subsidiaries with transactions of different legal characters connecting them, we're just going to take an eraser to all of that. We're going to ignore it. All of the, quotes, locations where business enterprises are present are effectively treated as branches, and we're going to allocate their financial income as if the legal constructions didn't exist, and indeed as if the country's corporate tax systems, premised as they are on legal constructions, did not exist. So in a sense, BEPS Pillar 2 is the purest form of profit splitting. They're trying to do exactly the same sort of thing. And that leads to a point that both Richard and I have made already this afternoon, which is that the essence of profit splitting is multilateral. That is, not only do taxpayers have to parse their circumstances on a multilateral basis, but tax authorities have to examine that way, and they have to agree with respect to each other's entitlements to the whole, even though those decisions may well be very dynamic on a year-over-year basis, notwithstanding the same theoretical tendencies.
Thank you, Scott. If I may now ask you, Richard, with your immense work on the risk allocation framework and on the BEPS project, how do you think and why the risk framework rules introduced by BEPS are driving a greater use of profit splits, and basically what potential challenges you may see from the application of the risk framework in the profit split method also application?
Okay, I mean, that is quite a big question. Probably the best way to respond to that is just to say a little bit about the risk framework and what it is. And then it makes sense to go from there to see what is its impact on profit splits, because it's not supposed to be driving profit splits. Although, as you've indicated, my view is that it does do that. So let me start off with a brief recap on the rules. Now, the whole the risk framework is essentially based on the notion of value creation. And value creation is related to the underlying theme of the whole of the BEPS project, which is correcting the artificial splitting of the location where profits are booked versus the location where profits are generated or made. The BEPS mission was to bring those together. Now, the value creation's never really been spelt out as to what it really means in any careful detail, certainly not in BEPS, but in very broad terms, it rests on the assumption that value is generated by human functional activity. In a transfer pricing context, the value creation doctrine requires what you might say is the primacy of relevant functional activity over merely legal arrangements, legal booking arrangements where there's a clash. That's exactly what the BEPS control of risk rules are intended to deliver. Those rules, the risk control rules that were devised in BEPS, effectively test the relevant legal arrangements that concern the assumption or allocation of risk. And the way they operate is that if the relevant human functional activity, and that's quite a mouthful, but it broadly means if the relevant decision-making about the assumption and management of risks is not aligned with the relevant legal arrangements, then the transfer pricing arrangements reward the entity or entities carrying on those risk control activities or functions, not the entity in which the risk is legally booked. And the focus of these rules that I'm talking about are on economically significant risks. So if you book your economically significant risks in Cayman, but all of the activity that manages them and decides to assume those risks is in UK Service Company, then UK Service Company is the entity that gets the bulk of the reward for transfer pricing purposes following the BEPS reforms. Okay, so that's probably a very unsatisfactory but very broad outline of the risk control rules. So let's turn to look at how this could be relevant to profit splits. Now, the answer to that is that we no longer look primarily at the relevant legal arrangements when we're applying the risk control rules. We need to focus on what is the control of the economically significant risks. And these are both quite contentious concepts. But what's key is the new focus on functional activity as the driver of profits. That's at the core of the risk framework rules. How does that fit into the transfer pricing framework and particularly the profit split guidance? Well, it opens the door to the argument that wider functional activity within the group that might involve one or more of other companies in the group is relevant for this control of risk test. Let me put that another way. It means that if some control of risk activity is present in a state, the tax authorities in that state might argue that it contributes significantly to profits consistent with the risk framework rules. And that means also that it would no longer be appropriate to reward that activity through a service fee, but rather the argument would be that it needs a portion of profit to be consistent with the risk rules, so a profit split is needed. So in other words, we're opening the door to picking up all sorts of human activity around the group that's part of the business process, and we're opening up the door to the idea that that might be a profit-generating activity requiring a profit split. That's essentially what's going on with the risk control rules. And indeed, what's going on, therefore, is that the risk rules create the environment in which different contributions across the group, which formerly might have been accepted as a simple service, are now characterized as requiring a profit split. And all of that is made more difficult by a number of factors. For example, the OECD guidance on risk, on the risk framework is not very clear in parts. There are some very important things that we don't completely know what they mean or what they require. Then there are arguments about how the law, even if we understood it, is fulfilled or met in practice. And then we find that the use of metrics to allocate profits is relatively undeveloped in the guidance. I made this point a few minutes ago, that we're increasingly using more compensation type factors, but the thinking on the use of compensation at the OECD was really developed in an investment banking, global trading context, where the underlying activity is much more homogeneous. So when we expand these factors based on compensation to other industries, which might include very diverse contributions as part of the business process, it really doesn't work very well, or it starts to break down. So the short point, and apologies, this is a long answer, but the short point is that the risk framework rules have created and continue to drive a number of very difficult profit split issues with some very difficult questions, a number of which remain unanswered.
If I may ask one of those very difficult questions that potentially will be answered or not, do you think, Scott, that it will be always easy to identify what is risk, what are the control over risk functions and functions that amount to assumption of risk, whether it's always easy to identify in practice who controls this risk, and sometimes the risks are external risks as well, so even all the risk can be controlled?
I think the short answer to your question is no, and for a variety of reasons.
Sure.
First of all, the OECD guidance, as constructive as it is or may be, conflates risk with function. And it doesn't say what risk means. I mean, in the example that Richard gave with respect to global trading operations, it almost, in some ways, matters less to have a sense of what risk means because of the homogeneity and the narrowness of the transactional pattern. I think when we speak about risk, and I don't think transfer pricing people are very good evaluators of what that means. What we're really talking about is the financial and functional capacity, essentially, to bear losses. I think losses in a large sense, and what the OECD guidance does is it conflates risk with responsibility, accountability, or functional operation. I think that in a large multinational organization, any of our participants in the webinar who have worked with them as taxpayers, and this is without coloring them or their behavior, would realize that there is very little that happens in a multinational organization that isn't directed, although carefully directed for PE and other reasons, directed from the top. That is, that the top is the source of capital raising and the facing of capital markets. The top is essentially the source, at least of the direction of ingenuity within the enterprise. Large decisions of any kind aren't taken without overarching guidance of the enterprise as a whole. So in some ways, speaking about risk of legally distinct or locationally distinct elements of the enterprise is a bit of a misnomer. And I don't mean to take us into this sort of so-called halo effect, which is a continuing question about in transfer pricing, about whether or not elements of the multinational enterprise are distinct. But I do see a little bit of schizophrenia too in the OECD's guidance, because on the one hand we have this very opaque development of risk in the transfer pricing context. On the other hand, also as an outgrowth of BEPS, we have the adoption of the DEMPI notion for intangibles, and concomitantly an acceptance that even those DEMPI functions can be outsourced to other enterprises as long as the DEMPI entity maintains overarching control over those things. So what that illustrates in my mind is that we really don't have a very good idea of how to identify what risk is or to measure it. And we are straining essentially to take representations of risk away from where ultimately the risk in terms of capital responsibility and ingenuity tends to rest in a multinational enterprise. And the reason we're doing that is because we've preserved the transactional separate entity paradigm, even though we say we haven't, and we focus on people functions, much as the guidance, the 2010 guidance for attribution of profits to PE does, which, and the last comment I'll make on that is that that's, I think, highly relevant. That is the PE guidance in relation to trying to understand what BEPS Pillar 2 is doing.
Now we have people, presenters from 2 different countries, and Canada and the UK. And as we know, the positions of Europe and across the Atlantic Ocean are always different. So my question is, do you see that states taking different views on matters such as what are economically significant risks? So we understood that it's very difficult to identify, but what would be the state position on that? Or where a control of risk decision is taking, value considerations due in respect of such decisions?
Well, let me have a first go at answering that. The preliminary point I'd make is on this question about whether everybody's on the same page or whether the states agree with the interpretation. Just a preliminary point is I find it very interesting to note that the effect of the risk control rules seems to have taken 3 or 4 years to really filter down to an operational level. That's my observation. And I think that did happen. So I think things have become clearer over the last 3 or 4 or 5 years, not from the immediate point at which the rules went live. However, as you indicated, I've spent rather a lot of time researching and writing on these rules. What I'm struck by is that there are completely different views, or some different views, amongst those who are actually in the room writing or negotiating these rules. So when you ask me, are there differences in interpretation, I'd say potentially there's differences on some very significant things from state to state, and that's not surprising because those who actually wrote the rules seem not to be able to agree now on exactly what they've created. And I'll just give you one example, and that's I'll just reprise, if I may, the example Scott gave, which is, if we've got a risk or an asset that is created by one company in year 1, and that's a massive capital commitment, a massive undertaking of risk, but then in subsequent years 2, 3, 4, company 2 plays a role in making decisions about the risk in that entity, let's say in a service function or otherwise, that has the potential to lead to great disagreement between the respective tax authorities about what's important and when's important. And that's because we don't really have clear guidance or clear understanding about how we deal with origination versus supplementary kind of decisions or functions. We don't have a system that works very well across multiple years. The system we've got tends to work better on a in-year basis. So the short answer to your question, Svetlana, is that there's a huge amount of things that people don't agree on, and these include not just what are the economic risks in a business, although that should be a question of fact, but on much more fundamental things like how the risk framework rules are intended to operate, in my experience.
I think that's right, Svetlana. If I can just, I'm just anticipating you wanted me to say something, but I think that's right. But in my experience, I think that the tax authorities, again, this is not criticizing the tax authorities. I think this is just human nature, actually, would say, well, if we can observe, activities of various kinds in our country, and they seem to be important in mobilizing access to markets, whatever we mean by markets and whatnot. Well, those are very valuable things. And historically, the Canadian tax authorities, for example, have tried to elevate so-called marketing intangibles to the status of a proprietary interest in intangibles as a pivot for saying, well, very valuable things are happening here. There ought to be an allocation in our favor. In my mind, it's always been the acid test for this sort of thing is to not talk about profits, but to talk about losses. That is, how do tax authorities feel about absorbing losses? So to take the example that Richard and I have both used, the country one and the country two. Let's just say there's only one paragraph. I think there's only one paragraph in the entire transfer pricing guidelines that deals with losses. And it says, oh, by the way, when we're dealing with losses, the same approaches apply. The implication of absorbing a loss is to shelter what would otherwise be taxable income going forward in that country so as to reduce the tax base. So country two in the example comes along and says, well, everything that happened after the origination of this asset has been very, very important. We, country two, are the significant contributors. We think we ought to have a higher claim on the accreting profit from the exploitation of this asset, wherever it's exploited, in country two or elsewhere, because we developed the valuable property. Well, what happens? So that is fine, because that gives rise to an affirmative positive tax liability in country two. What happens, if we're now talking about losses? Because for one reason or another, whether it's market-based or it's development-based, this asset is not yet profitable. Are the country two tax authorities going to say, no problem, we're happy, to take an allocation of all of those losses? Applying the same analysis, recognizing that the effect of absorbing those losses is to reduce future tax liability in country two for some considerable time forward. That's a rhetorical question, but my practical answer is probably countries are not willing effectively to subsidize each other by absorbing losses. And so all that example is doing is illustrating, again, the opacity that Richard has said, much more elegantly, that arises from the so-called risk question.
I guess you cannot get gain this without gaining also losses sometimes. So it's the other side of the coin, right? So if I would like to jump a bit into a different section and ask you maybe a bit of more challenging questions. So we discussed the risk. Of course, it poses like very significant challenges on identifying what is risk, how to allocate risk, what is the functional activity that identifies the control function and assumption of risk. However, do you also see any even more challenges with the rise of the new business models, digitalized business models that we discussed at the beginning, also platform business models or decentralized business models? So on the one hand, we see, of course, that it becomes a good way that profit split become a bit more wide, that provides you a wider perspective on the whole business operations, but how indeed to allocate different risks to so integrated activities of different entities in new, probably new, not only new, but also disruptive business models. Sorry, you can go, anyone, maybe Richard, go first, please.
Well, I'm sure Scott might have something to say on that. I've given you an example where not a new style of business, but where the guidance we've got, the example I gave you was on compensation, and that's been developed in an investment banking context, and it doesn't really fit very well for other businesses which are much more diverse. And so on. So that's an example. That's not a new style of business, but it's an example where we've got problems coming from existing styles of business to which the profit split guidance is being applied. Let me give you an example before probably Scott give you a much better example of new styles of business. But let me give you one example from my own practice of a new style of business, which I think raises some interesting issues. And that was the case involving algorithmic trading. And in that case, the trading algorithms that influence trading are produced in a separate process to the decisions to use or make effective and fund the application of those algorithms in trading. So in other words, you've got an initial exercise to work out what algorithms might be that influence trading, and then you've got a separate decision about funding them, applying them, putting risk control parameters around them, but implementing them. Now, it seems to me that what that does is it challenges the historic assumption, which I think the guidance makes, about what is implicit or contained in the trading decisional process. And that's because previously it's assumed to be subsumed into the single trading decision. In other words, all of that I've just described is assumed to be subsumed into a single decision. But what I've described is an example where that has been fragmented into two separate processes, if you like, only one of which is the trading decision as such. So I don't know if this makes sense, but what I'm trying to describe is a situation where our conventional assumptions about what trading is and committing to a transaction can be bifurcated or fragmented, and that makes the guidance much harder to apply. And so I think that's, in my world, that's not a bad example of where we have new challenges being created by new styles of business. And I see these issues as likely to get more prevalent and more difficult. But Scott, you might have some.
Yeah, no, I'd like to pick up on that, because I think the most important word you used was fragmented. I think the bane of transfer pricing as a dimension of essentially corporate taxation is the selectivity with which enterprises can decide where their income earning activities are considered to take place using very standard legal constructions, legal personality, like who's a person, and transactions of various kinds, which may be economically equivalent in many ways, but have quite different legal consequences because of their nature. So essentially, every multinational enterprise fashions for itself its own tax system based upon the combination of tax rules and its selection of legal constructions that suit its manner of conducting business and planning its activities. And that fragmentation was in some ways inevitable at the dawn of transfer pricing, which is long before the 1960s, reaches right back to the work that, for example, that Mitchell Carroll did with the League of Nations, because business at the time was cumbersome. It was physical, right? So you could actually see in relief, all of the gears in the watch ticking away, moving away, because that was the only way we could tell business time. What's really happened is that the relevance of time as an impediment to how businesses are conducted, how fast business transactions happen, and space, that is, over where they take place, has been compressed. I mean, that's not a new idea. Economic geographers have been talking about it for some time. So essentially, that leads us into the direction of profit splits, doesn't it? Because essentially what it does is say, well, all of the things that would have made the elements of business observable are essentially irrelevant to the conduct of business. It's possible for taxpayers to be everywhere and nowhere at the same time. The digital services tax advent is an example of that. Just to say, well, they're carrying on business in the source country, but they're not there. Their customers are there. What do we do about that? Have they just exited the tax system? That's an example of income allocation. It's an example, although not seen that way, of transfer pricing. And so what Richard has just given is another kind of example of fragmentation. It doesn't depend upon legal constructions. It depends upon perceptions of what the transaction or the transactions is or are, as the case may be. And even in his example with the algorithm comes into existence because it anticipates a whole array of transactions and makes the decisions about them in advance, so that it's not necessary on a case-by-case basis to exercise explicit specific decision-making, because according to a range of factors that are built into the algorithm, those decisions have already been taken if the facts of the moment conform to them. So, which is to say, the nature of business hasn't changed, but its reliance on time and space has changed. And because there is, and yet the transfer pricing guidelines and the operation of the profit splits persist, I think, as Richard said, in a way on a platform that is the old paradigm, which is separate entity transactional transfer pricing, profit splits try to overcome that. BEPS Action 2 tries to overcome that. But at the heart, what we have are perceptions, subjective decisions about what's more or less valuable in the circumstances and what is more or less contained within what we should regard as a transactional event. And still on a case-by-case basis, and still with a significant amount of discretion in taxpayers to select how that is perceived.
Thank you. If I can hear you correctly, and sum up a bit of these challenges in the business environment is the geographical location is the key challenge, and also the identification of the current forms, legal forms that potentially would not fit the economic substance indeed of the transactions. And we have different issues like mobility issues, artificial intelligence issues. We also discussed that in our previous webinar in for financial services, that artificial intelligence becomes very important challenge. Why? Because potentially decision making is also sometimes attributed to artificial intelligence systems. In addition, that it's not done by human, and the role of humans is quite huge in the profit split guidance, but also there is no identifiable geographical location. So indeed, time and space are the key factors that I think they put not only the profit split, but in general, the international tax landscape at certain danger of being outdated faster than potentially we can even think about it. But maybe in the sake of time, I would like to ask you a few questions also on how do you think what would be the way forward? And also not only in the light of the challenges specific to profit split method, but also to the wider developments. For example, the developments in the digitalization of the business, Pillar 2 developments. So now we see lots of globalization and multilateralism in international taxation. Would it lead to some profile expansion of the use of the profit split method? And potentially Pillar 1, we are not sure whether it goes through or not, but is it still feasible to have some certain solution for a digital economy, maybe also based on profit splits? And yeah, I would like both of you to give a summary of the main challenges and also what would be your view of going forward. Maybe Scott, starting with you.
Okay, 2 quick points if I can. I mean, at the end of the day, I mean, while it's very interesting, I think, to think hard and carefully about the theoretical underpinnings in a perfect world of splitting profits, I think at the end of the day, there are 2 questions. The first is profit splitting, however we conceive to do it, only works in quotation marks, inverted commas, if it's multinational, multilateral. And it only works if it's multilateral, if it leads to indisputable, real-time conclusions about what an acceptable profit split is. That is, taxpayers can't wait 8 to 10 years. Other tax authorities can't wait 8 to 10 years to find out, what, as it turns out, was the appropriate profit split in year 1. So that's a very practical question. And we know we already have a lot of insight into how workable or not, as the case may be, that is, because we've all had experience for countries that have tax treaties with mutual agreement procedures under Article 25, which very frequently is to resolve disagreements about the allocation of income within a multinational enterprise because there is a disagreement between tax authorities about the splitting of the profits, to use a loaded term. The other example that we have is advanced pricing agreements, which are supposed to be applying on an anticipatory basis, but both of those, in my experience, take years to come to culmination. So that's one aspect. No matter how theoretically refined the guidance may be, how does it apply in practice to resolve to outcomes? And secondly, how do taxpayers apply these dynamic perceptions in the minds of the tax authorities, at least, about profit splitting in a real-time basis and reporting their income with some degree of reliability? So that all leads me in the direction of, being maybe an adherent to the next least best approach, which is some measure of formulary, which is essentially what Pillar 1 is advocating. Because we don't know what the right answer is, but we would like to at least know the objective limits of the wrong answer. Because, for reasons that we've been discussing, in a very interesting way for the last hour, a common theme is we understand conceptually what profit splitting is about, but we don't really know how to get there reliably on an objective basis. So those would be my parting comments, Svetlana.
Thank you, Scott. Richard?
Well, you've asked a question namely about the challenges and what you might do about them. That does not only warrants a webinar in its own right, but probably a series or maybe a series of webinars, because it's such a big set of issues. So just in the couple of minutes that are left to us, maybe I'll just supplement add to what Scott's just said. One could say so much about these challenges, but I agree with his direction, really. The big general issue, I think, is with the increasing, or one of the big general issues is that with the increasing globalization, regionalization, digitalization, we see really enormously high levels of integration globally, regionally. We see dispersed management and control. And due to all of these developments, the M&E group is more and more being managed and run as a group, not a collection of separate and independent legal entities. And it becomes more and more difficult to get the tire levers out, to get everything into a single entity perspective, which is the assumption of the income allocation rules that we have, the transfer pricing rules we have. So I actually do see a growing unsuitability of a system based on separate and independent entities rather than on the group. That just seems to me what's happening in practice. However, it also seems to me that the appetite to shift radically away from where we are now with our international tax system and with our transfer pricing rules is very low. We see that in the way that Pillar 1 was a modification of the current system, but didn't fundamentally change the current system at all. It was just put on top of it. So I think from my perspective, my closing comment is that with all of the difficulties we've identified, we will be applying profit splits in future years. But for all the reasons we've discussed, it's going to be increasingly difficult to do so.
Thank you so much. And on this note that it will be increasingly difficult, I would like to thank you. And I would like to thank Scott and Richard for the contribution to today's webinar. And then we understood during this series that there are lots of challenges related to different industries, the identification of different factors and criteria for the application of the profit split method, but also the technicalities, how to apply it, and that it is also subject to change in all the dynamic environment that we now see in the international taxation. I would also like to thank everyone who contributed to this webinar series. There was Ala Ursu, Velia Moretti, Vladimir Starko, Rezan Okton, Federico Lobianco. And I would like also answering the questions in the chat section. The recordings are available, and these recordings of this webinar will be also available on our YouTube channel. So you can check the link on our website. Unfortunately, the recording of the previous webinar is not available because of technical issues, but we are considering also to re-record it. So potentially it might get live a bit later. With this, I also would like to make a few announcements about our next activities. And there will be, of course, a new webinar series already in the new year, potentially starting from October. However, we will also have 2 events in the meanwhile. We'll have one event on September 19. And this will be September 1920, sorry, and that will be a transfer pricing conference that you will have a chance. Also, we will all have a chance to meet physically and to discuss various topics of controversy and policy in transfer pricing. And the topic of the conference this year is business restructurings. And one more event that is already upcoming is our mini symposium, which is part of the LLM graduation, which will be on Pillar 2 and its interaction with other laws, and also special tax regimes for individuals. And with this, I'm wishing you a very good evening. I think it's a very special day, also not because of our webinar, but because of the Netherlands playing with England, and potentially you've seen me in orange today. That's just an accident, but I wish you a very good evening for this for today as well. So, and thank you to our speakers.
Thanks very much, Svetlana.
Thank you.